You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well on this Tuesday. I must admit, this week we are on a roll. It's like minus 20, minus 25 every single morning that I go for a run. So I come back with full of energy. All right. So let's get started with the BTSX for 2025. Yesterday I did a quick episode. Actually, it was a long episode about the fact that the BTSX failed to actually do its purpose, beat the TSX in 2024. And over the past 3 years, it also has underperformed. As also mentioned that it's not that important for a short period of time, but just want to highlight that even if you go with a very solid strategy that has proven to beat over and over your benchmark, always make sure that you monitor that strategy, that you understand what's going on, because nothing is certain going forward. And it's true for the BTSX. It's true for my strategy. It's true for any strategies. So let's get started today so imagine that you start the BTSX today, this year in 2025. What do you have in your portfolio? So I wanted to do a quick review of like the top 10 there. I mean, not the top 10, the only 10 stocks you should have, because if you have any other thing than those 10 stocks, you are not doing the BTSX. You are doing an hybrid or something else, and therefore your results will not be aligned with the strategy, right? It's like saying, oh, I'm following a keto diet, but I'm having like a pasta day and then a bread day, and well, you're not keto. You're just like trying to do something out of it, but not necessarily focus on a specific diet. So just to keep that in mind. So let's get started with Number 10, we're going to go from 10 to 1. TD Bank with a yield close to 5%. Quite interesting. I like that addition, actually. I see TD Bank as more as a deluxe bond for the next few years, mostly because it's going to be hard for them to keep up with other banks, because their main grower, like their main source of growth in their business, was the US market, and they are not allowed to grow there anymore. So yes, they're not going to go bankrupt. They're not going to do that bad. They're not going to decline. But my thinking is they're not going to do as well as other banks, because they do have to carry a heavy burden. It's like going on a sprint, but you have like around your ankles, you have like 10 pounds attached to those. You're going to run, but I don't think you're going to win the race. Canadian Natural Resources on number 9, 5% yield, very nice company. I really see this one for a long-term hold as a deluxe bond. A lot of investors were disappointed over the past few years, because in 2020 and 2021, that company was like skyrocketing, and now it's over. It's kind of like going up, going down, not generating that much returns. But if you look back at what happened after the financial crisis, that was pretty much a story for Canadian Natural Resources for a long while. So don't expect much for this one. Very stable, high quality asset. They will manage their production as according to oil price. So if commodity prices go up, it will go up. If it goes down, it's going to go down. And that's pretty much it. So you can buy it, sleep on it. You're going to get a good yield, better than most bonds. So that's why I call it a deluxe bond. Pembina Pipeline on number 8. Another one that is a common player here. Very stable. The pipelines are really those type of businesses that are stable. They're paying a high yield, and the only thing that you have to watch for is the payout ratios and making sure, and I say payout ratios, so you will look at the classic payout ratio, the cash payout ratio, and the distributable cash flow payout ratio. You look also at the debt level, and as long as those things are relatively stable, you're going to be fine with Pembina. That's a good pick if you're looking for income. Power Corp, well-diversified company. I kind of like half of their business and the other half not so much. So number 7, again, another case of a deluxe bond. This one is a cash flow making machine, but I still have doubt about their stake into IGM, so Investors Group. I don't know how they're going to be able to grow going forward, so I'm not 100% convinced about this. But again, deluxe bond, Yeah, over 5% yield. That's good. Emera, a classic utility, what was one of my favorite as of like for several years. My favorite has been Fortis for several years. But Emera was not too far behind because I liked the fact that they could grow in Florida. They reported like shaky dividend triangle over the past few years. Now I see it more as a deluxe bond. It seems that it's going to be a little bit harder for them to grow moving forward. A lot of competition in Florida, even though it's a great state to grow. But again, not really worried about this one. So like position 6 to 10 seems to be like relatively interesting companies if you're looking for yield, and I don't see those like crashing and burning. Speaking of crash and burn, Algonquin is number 5. I mean, dude, they cut their dividend twice. They're still trying to manage their debt. They are not in the growth mode anymore. This one is really not part of my favorite. Yes, I got burnt. Maybe I am biased, but I don't see the growth story here. So you're buying a stock in the hope that it's going to eventually get some love from the market. This is not my strategy. Number 4, Scotiabank. Again, if I have to select any banks out of the big 6, Scotiabank will probably be number 5 or number 6. Again, it has been ranked at that level for the past 15 years. So I'm not new of not liking Scotiabank. The company, I mean, yeah, they're making an interesting turn, trying to clean up their South American presence and for focus more on classic banking activities. We'll see how it goes. Still not convinced that they will be able to keep up with Royal Bank and National Bank. Enbridge made a major comeback, such as TC Energy, and you're gonna like notice TC Energy is not there anymore. So that is one thing that it sucks with the BTSX. A few years ago, you had Manlife. Manlife skyrocketed. Well, now it's time to sell this one and buy something else. So Enbridge is still there, but of course, you started the year 2025 by selling TC Energy, and now you're stuck with Enbridge and no more TC Energy. Did a good year. The yield is now more in a good territory, slightly under 6%. Kind of like that. Long-term deluxe bond. I don't expect much though. I mean, if you look at the stock price for Enbridge, it goes up, it goes down. It's just the classic holding that is going to happen with Enbridge. So you really buy it for the yield, and from time to time you're going to have a good year in terms of the stock price, but it's usually was followed by the buy. It was usually preceded by a bad year. So you're not necessarily gaining that much over time, but overall, very stable business, not about to die. So again, not a bad pick. You will notice before I move to the top 2 that all of those companies I have a general comments about. Yeah, okay business model, not really much growth, and you're gonna get it for the yield, but don't expect much out of this. It's pretty much my thinking about high yielding stocks. By high yielding, I'm talking about companies paying a high yield above 5%, which is the case for all of those. And actually, I did a research comparing high yielding stocks to low yield, high dividend growth companies. And the results were shocking because it's not only that, like a lot of people will think, oh, if you go for low yield, high dividend growth, you're going for more volatility. It's not the case. And actually, it's safer to go with those low yield, high dividend growth stocks. If you're curious about how I came to that conclusion, you can download Dividend Income for Life Guide and see the full research, the comparable over 10 years period. And I even did an update to show you if I had to do the comparison again for the next 10 years. Well, we're already 1 year in. You have the list of the high yielding stocks and the list of the low yielding, high dividend growth stocks inside the Dividend Income for Life Guide. So you can download it at moosemarkets.com/income. It's moosemarkets.com/income. You're gonna get the comparable, and on top of that, a way to build your portfolio if you're about to retire on those low yield, high dividend growth companies. Moving up to the last 2 position. Both telcos. I'm pretty sure you know where I'm going with this. Number 2, TELUS. This is the only company I own. No, that's not true. I also have shares of Canadian Natural Resources and in a few shares of TD Bank in my Smith Manager, but TD Bank doesn't really count. So really, CNQ and TELUS are part of my portfolio. TELUS, I used to love that company. It's still holding it right now because the cash flow situation has improved in 2024. So cash flow from operation was growing, the free cash flow as well, and then the capex was reduced. Most importantly, free cash flow was enough to pay the dividend, which means that TELUS is not forced to borrow money to pay the dividend in 2025. Now I'm looking at what's going to happen. What is really important for me is to know what will be the new dividend growth policy for this one. My eyes are on that. So I can't wait to get the next quarterly earnings to know what management intends to do with the dividend growth now that they have finished their cycle of increasing their dividend by 7% a year for a long while. So that's going to determine a lot about my thought about TELUS going forward. Of course, track the cash flow metrics every single quarter for this one, but it's still definitely in a much better position than our winner for the BTSX this year, Bell Canada BCE, offering a yield around 12% now. Kind of crazy. I would have not thought that the Bell story would have go down that fast. But the thing is, there's not much positive going around the business. The company will likely continue to struggle generate revenue growth, which is a problem. It's going to struggle to show EPS growth, which is another problem. And the most important problem of all is they're not going to be able to generate enough cash flow to maintain the business, invest in new projects, invest in their fiber business in the US, grow their dividend. I mean, they're not going to grow their dividend, but even just pay their dividend and pay that interest charges that is growing like there's no tomorrow. So a lot of concern here. Not too sure I would like to have this one as my number one pick for the BTSX in my portfolio. So I'll leave it that to you. Do your due diligence on all of those, super important. And if you are curious about the difference between high yield and low yield stock, go to moosemarkets.com/income and download the report now. You'll see, you will be shocked. All right, Moose, enough for today. We're going to talk again tomorrow. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.